Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Let's go straight to the headlines. Stocks in Asia open mixed after a lackluster US session as investors await Fed Chair Jerome Powell's address at the Jackson Hole Symposium. Indian equity benchmarks fell to their lowest level in 6 months and the rupee declined to an 8-month low amidst global and local economic concerns. Chief Economic Advisor Krishnamurthy Subramaniam advises against a fiscal stimulus, argues that using taxpayers' money to support industry is a moral hazard where profits are private and losses are socialized. The government notifies an amnesty scheme that allows taxpayers to settle outstanding indirect taxes without interest, fine or penalty. And in corporate news, Amazon takes the plunge, buys 49% stake in one of Future Retail's promoter entities, Future Coupons. The world's largest e-tailer also has the option to buy out Future Retail's promoters from the 3rd to the 10th year, subject to rules allowing that. However, it's a day of maybe 1 or 2 corporate news, but the more important thing is what's happening to the world at large in the markets. Now, the world markets were very, very flat. Frankly, if you pick up any of the European or the US indices, take a look at what Asia is doing. It was largely a flat day for the US markets and the European indices, and it seems to be, it's starting off like a flat day, marginally in the green, but flat day for the rest of the Asian bourses. And due to our own issues that we have, the SGX Nifty, of course, indicates a start which is marginally in the red and not in the green. The key is it could very well worsen during the course of the day. Now, frankly, I mean, what happened yesterday, and a lot of people, even post-marketers, were perplexed as to what happened. To my mind, I think the CEA batting against the stimulus was the key reason. The key plank on which the market was holding on to some hopes of an upside gave way, and therefore there is an exaggerated reaction. Can the same thing happen today? Maybe. Can it bounce back from here? Maybe. But the fact that the CEA says that they're using taxpayers' money to intervene when sectors face stress is a moral hazard when profits are private and losses are social is the key thing. I mean, that just gave way to the flip-flop that is happening in media circles about whether the stimulus is coming and what time is it coming. I think this should put pay any kind of hopes that the market had about an immediate stimulus. It could well come tomorrow. It's very unpredictable, really. But when the CEA is saying this, you would probably give it some credence and believe that maybe, just maybe, let's not be too hopeful from a market's perspective about a stimulus coming in for specific sectors or otherwise. Having said that, in an interaction yesterday that Nitin Gadkari did with one of the channels, I think ET Now, he said that they are working on some stimulus for the auto space as well. So there's a lot of flip-flop, and therefore I think it's pertinent to keep in mind that it's foolhardy to take a trade on the basis of an expectation of a stimulus. And the absence of any near-term triggers, I think, leave our markets, one, at the mercy of what's happened to global cues entirely, and two, that downtrend and that sentiment downtick might well continue. Just look at what India has done versus what some of the other markets have done in that period. So Nifty's fallen about 11% from life highs. This is June 3rd, I presume, when we hit about 12,000 mark. From there on, India has fallen 11%. The other markets have fallen maybe 3 or 4%. So there are clearly India-specific issues that are now coming to the fore. And FIs continue to desert the market as well. The FI number was a large number yesterday, about 903 crores. And despite 1,700 crores of buying from the DI community, it hasn't really helped. And lastly, well, speaking of FI views and people who advise the foreign institutional investors, Chris Wood came out with a note. It's a very large note. It'll be put up on the website very shortly as well. But the key thing is that he's reduced the Indian overweight further by 1 percentage point. This is the greed and fear. Jeffries, Chris Wood, greed and fear, and it reduces the Indian overweight further by 1 percentage point. So tells you the story about maybe how foreigners are viewing as well. Speaking of that, actually, today, all that we're going to do in First Word is try and get you very important market opinion, very important domestic market opinion, and important rupee opinion as well. Start off with Andrew Freris, CEO, Recognosis Advisory, joins us right now on the show. Well, macros are hurting India. The world is looking out to Jackson Hole Symposium for some indications from Jerome Powell. What is Andrew Freris looking at? Andrew, good morning. What are you looking at?
I'm definitely not looking at a Wookiee Hole. Okay, whatever has come out of that has been, in general, of very little market significance. They're very welcome. They have a very nice time. They play golf. and they talk about markets. And Powell is under pressure to cut interest rates. I know half the Fed, at least in their last meetings, were against. There is colossal pressure coming out of Trump, which rightly he's resisting. But given the state of the expectations concerning Fed, I would be very surprised that they don't cut interest rates again. So I will do something else rather than spend my time at Wookey Hall, I'm afraid.
Okay, not fretting on it, but would you believe, Andrew, I mean, just because markets would tend to react a bit if indeed the Fed chair were to speak something really out of the ordinary at the Jackson Hole Symposium. It's not a rate-setting meet, but just an opinion meet. Do you think there is a place and time for talking something which might help the markets?
It would be quite inadvisable at Jackson Hole for him to say anything that sort of presages a next move by the Fed. You know, that's not the business of the place. We're going to get a lot of blah blah. Come on now, by now everybody, possibly including me, okay, precisely because the markets are completely all over the place. There is really no basic understanding why they're doing so, except the concern that something could go wrong and the Fed is expected to do something about it, disregarding the fact that there is the rest of the world around. You know, we have become completely Americanocentric, and I'm really fed up about that. You know, United States doesn't drive the world. All right, there are a lot of other much more important things that are happening right now, okay, that do not necessarily relate to the United States. I'll tell you something which I'm really stuck on it. I've stuck my neck out and I'll stick my neck again. UK is not going to leave, NO is not going to leave the European Union. This is enormously bullish for the euro, and it is enormously bullish for the European Union. Okay, and I do believe this is going to happen, not because it suits me or because I would like it to happen. And that is a huge plus point. If somebody tells me, what are you buying right now? I will say, in a portfolio which is relatively unbalanced, I will definitely be very bullish on the euro, very bullish on the pound, very bullish on the FT100, and very bullish in general on European equities. Why? Because UK will not be able to leave. And that is a hugely bullish point for the European Union, that everybody has been saying it is dead, it is dying, it is of no importance whatsoever, and so on. Well, there you are. I've got something that concerns me much more than what Powell is going to say at Jackson Hole, frankly.
Andrew, will that alone help the Eurozone economy as well? Because one thing is what happens to the exit or the non-exit. The other thing is what the economies themselves are going through.
Well, absolutely. Remember, the stock markets and the real economy are completely decoupled. That's forever. I mean, it's nothing new. Okay, what the GDP growth is telling you and what the stock indexes are telling you are completely different things. No, I'm interested right now the impact on the financial markets, because this is not going to in any way reverse the deceleration in the German economy, which incidentally everybody blames it on Trump. Okay, anything that goes wrong, it is of the trade war. Look, the trade war is between China and United States. It is not between United States and the rest of the world. You know, I will challenge somebody to tell me what has Trump done to really damage Germany. I'll tell you, he has imposed some tariffs on steel. That's it, full stop, nothing else. And if that caused the German economy to collapse, then we are looking at some really very, very weak economy. German economy has slowed down for a lot of both cyclical and structural reasons. Same thing with India. Okay, Trump removed the preferences on Indian exports. Okay, well, exports are a minimum drive in India's GDP. Okay, they could lose all the exports to the United States, and the impact on that GDP is going to be a few basis points. India is driven by domestic factors. So, you know, for a change, I don't particularly like what Trump does, but I don't want to blame him for everything that goes wrong in this world. Okay. Sorry, I'm getting a little bit, I would say fed up, but a lot of the stuff is factual as opposed to simply opinion.
Well, POTUS would like listening into this conversation. Andrew, one final question though, since you mentioned India. We've had some issues of our own. The Indian markets have declined the most since the peak in June 3rd compared to the rest of the world. How do you view India now?
In terms of overall market, look, for the market to fly in the context of a global market that feels a little bit happier, In other words, if the G3 markets are not doing well, it's very, very difficult to see how the Asian markets will do it. Okay, so what I would buy India, it will be on policy initiatives, and we're not going to get any. So I definitely will not buy India for the fabulous macroeconomics that I'm seeing in front of me. Interest rates have been cut, okay? But so have Thailand cut interest rates. Hong Kong, of course, had to cut interest rates when the Fed cut interest rates. China has definitely loosened its monetary policy, although necessarily the interest rates. So, I will not be pointing at the Reserve Bank of India and say, hey, that's the good news as far as the equity markets is concerned. So I'm afraid India is in the same bag with anybody else, with nothing specifically special. And of course, there is the Kashmir issue, but that's primarily economics rather than finance. But these things don't help.
Okay. Yeah, but I think Chris Wood today has made that point in his note as well. Andrew Freris is making that point too. Maybe people are looking at it more seriously. Andrew, thanks so much for taking the time out and joining us this morning.
It's a pleasure. Thank you.
Well, we'll not look at India. I think Indians are not looking at India as well. Ajay Srivastava, Managing Director at Dimensions Corporate Finance Services, joins us right now on the show. And Ajay, really appreciate you joining in, but you obviously, the market yesterday, the comments that came in from the CA all lead to some fairly serious introspection on what to do now. We've probably been the worst, or we have been the worst performing market since the peak on June 3rd. The question is, if indeed a government-induced stimulus is not coming in a hurry, or it's difficult to predict, what happens to the market in the intermediate term in the absence of almost any trigger that we can look forward to?
Good morning, Neeraj. I think as investors, we need to look at three things. One is we need to start as Indians start to look at a global market for investment, not just focused on India. 99.9% Indians have got 100% equity investments in India. And I think it is time for them to start looking elsewhere as well, because if you see the conduct of what's happening in the U.S. and India, it is so stark. There has a president gunning for getting the economy back and seeing it up. Here we have a flippant CA, attributing some demonic transformation of the economy to this slowdown. So, the comparison is so odious at this point of time that you would wonder, why have you invested any money in India and not in the U.S.? So I think the first lesson for us, instead of trying to understand when the stimulus will come, if it comes, because I hope people have heard the old adage, a stitch in time saves 9. What could have been done with 100 rupees now will maybe need 500 rupees. So I think the first step Indian investors should look at is, please diversify your investments across the world, particularly United States, rather than just sticking to India and living with it. Number two, having said we had a steep correction, if you look at the top 10 stocks, Neeraj, which is, let's say, HDFC, Bajaj, etc., they're not cheap by any standard given the economy at this stage. Even today, they're running at a PE of 25 and abouts, and they're about book values of 8 to 10, like Bajaj Twins, etc. So you're not saying that some of the stocks have become as cheap as they should have been given the economy. Number three is, you must understand that there is a big problem happening in the economy, that the MSMEs are still paying interest rate between 12 and 18%. And you're right, Neeraj, I'll tell you, we have a company who's come to us for restructuring. SBI levied an interest rate of 18% because they couldn't meet the covenants. Have you ever heard you talk of interest rate reduction? They levied 18% interest rate, ICICI and SBI. So wow. The interest rate chimera of reduction is all for the newspapers. What is the real rate being paid by the real India is 12 to 18%. Unbelievable, but that is true. So in that scenario, I think three things are very ordered. Don't fret too much. Diversify your holdings. Don't invest. If you got the money, just keep it there. Whatever you have investment, it's mostly should be underwater by now. Just hold on to it and hope it turns around. At some point of time, it will turn around. And as we said, this is the best time to buy a house. If you have money, just go buy a house if you wanted to, rather than just trying to double your money in equity. So all in all, live with it, but diversify.
Ajay, for now, okay, there are a couple of things. I mean, experts like you, I think with interest abroad as well, likely could diversify in a much easier fashion. I think the costs of buying equities directly abroad is a bit more prohibitive for somebody whose investment corpus is not as high. So my question is, again, from both people's perspective, I take on board your point that if you have the wherewithal and if you have the money, go out and try and diversify out of India too. It's just prudent, irrespective of what's happening right now, it's just prudent to do that. For people who can't do that, what's the belief that you have right now about the near term, looking at the economic forces at play? looking at the responses from the finance ministry, PMO and otherwise, and the fact that earnings are at least a month and a half away and they do not promise to set the stage on fire, would you believe that there will be a slow drag downwards for the Indian markets from where they are right now?
So three things. One, you asked is, what do people do who can't buy equity overseas directly? I think you still have a window of U.S. mutual funds, particularly available in India. Some mutual funds are international mutual funds, which is not a bad way to get into the U.S. markets and international markets. They're pretty decent funds, and the portfolios are quite decent. We have analyzed them, and we use them ourselves. So it's quite decent to put the money, and you need to put the money in rupees, so you're not even worry about norms, using your norms quota, etc. So to that extent, even a small retail investor with 25,000 can start participating in the U.S. market. It's quite simple. Number two is, even when we look at this Indian economy, I think there will be few bright spots as always. You see, IT was absolutely fine yesterday. Nothing went wrong with IT. IT will remain to be a good bellwether for Indian investors. If you are there, keep it going. If you're an FMCG, MNC, keep it going. Sooner or later, they will keep rewarding with dividends. I think the key question has become that what do you do with the old economy stocks? And that is where the dilemma is. And number two, biggest one, 90% of Indians hold large holdings in banking. And I think that's where the big damage is coming, because barring one or two, even HDFC has dropped 10% at this point of time. What do you do with banks? I think you need to just stay put with top three companies of every industry. And hopefully when the market turns around, you will see the top three companies giving you extraordinary returns. Trying to do the alpha by small and mid cap is going to be as disastrous as been for the last 2 to 3 years. I think that's the moot point what we are telling all our investors. And the last point is earnings. At this point of time, earnings makes no sense, because you need to start looking at companies based upon their book value to market, their fixed assets to market capitalization, their debt to EBITDA multiples, because earnings will not justify anything at this stage, because this festive season looks to be pretty rotten by any standards. So start looking at the portfolio more in terms of what the valuation of the company is to intrinsic assets, then just look at the earning potential of the company. So as I repeat myself to summarize, we look at the top three of every industry and stick to that. And if you want to go level below, please look at intrinsic value of the company and if they are debt-free and compared to the asset of the company. If you think they're right and some of the commodity players perhaps would qualify for that investment, then you may stick around with it or maybe make some investments, because that could what give you alpha return whenever the market turns around. But banking on earnings, I think that would be a fool's paradise.
Okay. Well, and if you can't calculate intrinsic value, then go and do some course before going out and trying and being a brave heart out there. There are very pertinent points made by Ajay. Ajay, I would request you to stay on, because we are also joined by Ananth Narayan. He's professor at SPJ Institute of Management and Research. And I think the other part of this equation is what's happening to the currency as well. Ananth, good morning, and thank you so much for taking the time out this early in the morning. What's your sense now, Ananth? From the money market perspective, I think the bond markets were getting rattled at what if there is a large stimulus coming. If what the CA said yesterday is the course of action, then we may not have that coming. Bad for equities maybe, not as bad for bonds?
Yeah, it's a tough spot, Neeraj, and morning to everybody. Look, the reality is while the market waits for a fiscal package or some kind of palliative in what clearly looks like very, very tough times, we have to remember that the fiscal situation isn't looking good, and we really don't know how much space is available for any kind of meaningful stimulus packages at this point in time. For the last 2 years, the actual real fiscal deficit numbers are far higher than what has been declared so far. Even for the last year, FY19, while the government says it managed to meet 3.4% of fiscal deficit, the reduction in tax collections and the off-balance sheet management of Food Corporation of India bills, of bonds issued serviced by GOI, and the ratcheting up of distribution company debt on the state level, all of this portends that the actual real fiscal deficit is far higher than the 3.4%. It's probably closer to 4.5% for last year, and could be the same for this year as well. Now, of course, we have a new paradigm globally right now where every other country seems to be doing the same thing, having monetary easing as well as fiscal easing at the same time. So the pertinent question which could be asked is, why not we do the same thing? Why don't we spend a little more from our fisc? The starting point, though, has to be a recognition of what the real math looks like, and a recognition that past experiments of fiscal and monetary easing have not ended well for India. 2012, 2013 should be fresh in our minds. Too much of fiscal spending, too much of monetary easing at the same time can lead to higher imports, can deteriorate the current account deficit, and can therefore also lead to outflows of dollars when the confidence breaks in the system. So it's a kind of funny situation, Neeraj, that we have to be careful about. I think at this point in time, the currency is buffeted by a few things. One is clearly there is a bit of crisis of confidence. FII monies has been going out in drips and drabs, but nevertheless steadily throughout the course of August and even before that. Second, the global context is not looking great. You have the Chinese yuan, which is well above 7 now, and the dollar has been strengthening as well. And from a real effective exchange rate perspective, India continues to be overvalued. Rupee continues to be overvalued. So that's kind of hitting us at one level. For bonds, of course, the dovishness of the RBI helps, and that's great news. But the questions about the nature of the fiscal balance and the fact that the government eventually has to borrow, if not directly, then indirectly through other entities, is keeping bond markets nervous as well. All in all, not a great sign. The good news, though, Neeraj, is there are ways out. We don't have to just waste our time only talking about a fiscal package or a monetary easing. There are real reforms which can actually address the core issues we have in our banking sector, NBFC sector, power sector, manufacturing, and factors of production sector. All of these are real reforms which we should be spending time on rather than only talking about monetary and fiscal easing. To answer your question, long story short, money markets will continue to be nervous. Fundamental confidence is not looking great. Fundamental factors aren't looking great. I still think we will do well eventually, as long as we proceed on the path of real difficult reforms rather than just concentrating on the painkillers.
So and therefore I'll wrap this with one question to both of you, and Ananth, to you first and then to you, Ajay. I'm sure there are ways, and social media is agog with the quantum of opinion coming out about how to go about fixing the economy. Raghav wrote a piece yesterday about the 9 things that can be done in Navratri for rebooting the economy, and I'm sure both of you have an opinion or two about this. My question is, the government obviously knows this. There is, in the eyes of some people, Ananth, a bit of a delay in making measures or taking steps which can be quick fixes or immediate fixes. Why is that? And is there something that can be done as a quick fix right now to just soothe the nerves which are clearly frayed?
I'm adding to the cacophony, I realize, but I will do it since you asked me, Neeraj. The starting point, I would say, is don't look for quick fixes. That is always going to give you the suboptimal solution. We have to take those hard, tough reforms. If you look back at the budget of July of 1991, when Dr. Manmohan Singh rose after the crisis in 1991, that was path-breaking. The time is ripe right now for a similar path-breaking kind of set of steps to be taken. And we don't have to wait for a crisis. So my suggestion would be, don't look for quick fixes. There are structural issues in this economy which need to be addressed. Start with stuff like banking. We know the banking system is still hurting. The NPA resolution is not coming through despite a great insolvency and bankruptcy code. We probably need to ponder ways in which we can isolate the bad debt separately, get the banks to start worrying about new business rather than the gross NPAs. We have to find a way in which the NBFCs can be resolved. We have to find a way in which banking reform can come through. Power sector, this is a can that has been kicked down the road for ages now. We have to find a way in which we can resolve that as well. All this calls for hard reform. Finally, on manufacturing, etc., you need land reform, you need labor reform, you need capital reform. None of these are easy, Neeraj. The reason why I think we are kind of hesitating to doing all this is going to be painful. This is going to be really hard. And these call for tough decisions. My only point is the government today has plenty of political capital. It's best place to take steps like this. I do hope eventually we go down that path rather than saying, oh, this is like boiling the ocean, too tough, let's avoid this, and let's get back to a fiscal or a monetary easing and then hope for the best. I don't think, just these palliatives and painkillers will help. We have to go in for hard reforms. I wish and pray that we don't wait for a 1991 type of crisis before we embark on them. I hope we do it on our own rather than waiting for a crisis.
Ajay, the market is actually hoping for the reverse, isn't it? Maybe some quick fixes. They might be bad in the long term, and Ananth's point is well taken. But in some measure, I've heard a lot of people say reduce GST for 6 months to a particular rate and then go ahead. So some quick fixes, whether or not they really lead to the long-term improvement or no. Would you be in favor? Would you be against that?
Well, people who've all been talking about reforms, due apologies to Ananth, have all led this country to where we are. We had the greatest reform in the last 3 years, demonetization, GST, IBC, and look where we are ended up today. So I think reforms, I don't think we use the word reform. I think there's some very simple thing the government has to do, nothing to do with the reform. First of all, the government has to pay up to all the people the money which is under litigation. If you look at all our road transport companies, all the contractors, all the defense suppliers, all the suppliers to the seed corporation, all the suppliers to the government of India, I think they got thousands and thousands of crores today stuck with the government under various litigations. And half our NPA problem comes from these accounts where on one side money is due from the government and the other side the banks are saying pay us the money and you are caught in between. So one is, can the government for an interim pay up this money, whether through escrow directly, and see that the money flows back through the corporate balance sheets into the bank accounts? Automatically you will see 20%, 25% of NPAs will disappear because on the other side, it's the government which is litigating. That's one, I think very clear. Number two is, you have to announce something for the small and medium. If you notice, look at the newspapers. The auction notices are heart-rending in terms of what people are losing in the SME sector. Some kind of moratorium to allow people. If the economy is tanking at 28% minus for automobiles, how will the smaller companies, ancillaries, pay up the loan? You can sell their houses, but you're losing economic value for a long time to come. So it's very simple. You have to take care of the SME at 2 levels, interest rate, and stop just selling everything that they have, because the big guys, no assets are being sold, the small guys losing the house. I think it's as simple as that. And the third most important, I think in my personal view, is that the government needs to just sell the PSU companies. I think that is where the biggest hole is. If you look at the market capitalization-wise, investors lost largest sums of money in the PSUs. None of the PSUs are now making any large profits. Dividend has been squeezed to the last penny out of them. So if you have a big plan to sell the PSUs, I think you've got serious amount of capital and firepower in the system. And fourth, I think Ananth rightly said, power sector. Half the dues, if you look at GMR, GVK balance sheet, what are the dues? The dues are power projects set up with the gas supply, which never happened to them. Now, you may penalize them, you may kill them, you may put them in jail, but the fact is, it is out of their control. So if you can address the issues of all the power suppliers who had got gas connections and who did not get it and then became NPL, which is quite a large sum of money, I think you're taking off stress from the system, which is hampering even good quality asset. In those two cases, the two airports are getting hampered. So I think, more than reforms, a simple way of managing the day-to-day affairs of government versus private enterprise can change the way India is, at least in the short term. And I'm not a great believer in reformists, because that doesn't end up anywhere in a country. Do simple things correctly, and mostly you'll find economy turning around.
Well, let's hope somebody's listening into these conversations. Chris Wood made the point in his note this morning that the single biggest drawback, according to him, of this administration is still holding on to public sector enterprises. A shameless plug out here. We are doing a piece called The Real Economy Check. When we're talking to small companies, 25 crores to 150 crores, we try and get their pain points out. Couple of episodes shot already. Urge everybody to look at that. Ananth, Ajay, thank you so much for joining in today and giving us your perspectives. Really appreciate both of you gentlemen taking time out this early in the morning and giving us your thoughts. Well, very important views. We need to slip into a short break. We've focused on the markets thus far. Now we'll try and focus on the immediate term. Some stocks and news, what to do in the near term. Devin Choksi, Amit Khurana and Chakri Lokpriya of TCG would all be joining in to give us their thoughts. We take a look at the road ahead for the Indian drug makers as competition intensifies with Sujit Pal of Prabhudas Liyadhar. And how bad is the hangover from consumption slowdown for liquor companies? Shekhar Ramamurthy of United Breweries would join in to talk about that.